In this video, we're going to discuss the difference between an open-end and a closed-end mutual fund. So with an open-end mutual fund, we're going to determine the price by just taking the net asset value of the fund and dividing it by the number of shares that are outstanding in the fund. The closed-end fund, our price is going to be determined by supply and demand. It's not necessarily going to be the net asset value divided by shares outstanding. It could be, but it's probably not going to be. It'll trade at a discount or a premium. It'll be at or below this number here. Now, you might be saying, that's weird. Why is that the case? Well, the reason is that with a closed-end fund, you're purchasing the shares from an exchange. So there's an exchange with buyers and sellers coming together saying, I want to buy shares of this closed-end fund. Other people saying, I want to sell shares. And so supply and demand is just going to determine what the price is. Now, with an open-end fund, you're not buying the shares on an exchange. You're purchasing them directly from the fund, from the mutual fund itself. You say, look, I want some extra shares, and then they can actually increase the number of shares for the fund. Whereas with the closed-end fund, the number of shares is fixed, and so you have to buy them from somebody else who wants to sell them, from another investor. And another difference is that, so these transactions, when you buy on the exchange, the transaction is going to be executed as soon as possible. And I don't say immediately, because there might not be anybody willing to buy your shares if you decide to sell them or so forth. Or if you want to buy, there might not be anybody willing to sell at the price you're interested in. And so in any event, it's real time that this is happening, right? It's just like buying Microsoft stock or something. With an open-end exchange, all the transactions are going to take place at the end of the day. So you tell the mutual fund, hey, I would like to buy 400 shares of your mutual fund. And they say, okay, at the end of the day, they're going to calculate the price by taking the net asset value of the fund, dividing it by the number of shares outstanding. That's going to be the price, and then you're going to get the 400 shares at that price. If you don't know what net asset value is, I check out the other video that we have on that. So I just want to give you an example to make sure that this is we've been talking abstractly here. Let's say that you buy 400 shares of an open-end fund. Okay, so we're talking about the open-end fund. Then we'll talk about a closed fund later. So first thing is that the trade, right? So you want to buy this 400 shares, that's going to take place at the end of the day. Even if you say at 10 a.m., I want to buy 400 shares, the mutual fund doesn't execute that immediately. They wait till the end of the day. So before the trade takes place, you have the fund has assets of $6 million, and the fund has 40,000 shares outstanding. So you take the $6 million and divide it by the 40,000 to get the net asset value per share. Now you might say, why does this matter? Why do we care about this? Well, because we want to know the price, right? This is the price you're going to get charged. You're going to get charged $150 a share for these 400 shares. Why? Because that's the net asset value per share. So, and then again, this is going to be executed at the end of the day. So what are the fund's assets going to look like afterwards? Well, now the fund is going to be afterwards $6,060,000, right? Why is that the case? Well, because we have this 150 times 400. And let me actually write that out here. 150 times 400 is going to be 60,000. And so you add this 60,000 to the 6 million in fund assets that were started with at the beginning. And so afterwards, the mutual fund is going to have an extra $60,000 in assets under management. Why? Because you just paid $60,000 to the mutual fund for the 400 shares. Okay. But now this number of shares outstanding is going to change too, because the mutual fund issued 400 more shares. So now the number of shares outstanding is going to be 40,400. So we say that an open-end mutual fund has an unlimited capitalization, in that this fund assets number, this can just keep going higher as more people decide that they want to buy assets, or that they want to buy a piece of this mutual fund. They want to invest in this mutual fund, so this number can just keep going up. Alternatively, it could go down when people decide to sell. the number of shares outstanding can keep going up as the fund issues shares to people. So the net asset value per share, that has not changed. That's still going to be $150. So the price you paid, $150, is just the net asset value per share, and the fund's assets increased. The number of shares outstanding increased because you have added capital to this fund by buying in. Now with a closed-end fund, things are going to operate very differently. So the trade is going to be executed immediately, assuming that there's you're wanting to buy the 400 shares, assuming there's someone willing to sell 400 shares right now to you, then it will be executed immediately. If there's not somebody in the fund who already owns shares willing to sell, then you're out of luck. So, of course, you could just be willing to pay more for the shares, and then that'll entice people to come and sell their shares, and that's part of the supply and demand that's going to affect the price, which we're going to get into in a moment. But first, let's notice we have the fund assets, the shares outstanding, and the net asset value per share are all exactly the same as our example before, right? So I just want to clarify that because there's going to be some differences now when we come to the price. So you say, okay, well, how do we determine the price? Is it just this 150 that it was under the open-end fund? No, it's not. The price is going to be determined by the market, by buyers and sellers, the same way that the price of Microsoft stock or Coca-Cola stock is determined on an exchange, right? So let's say that the market price of this is $135 a share. So that's the price. Now you might think this is weird, and you say, why would they only want $135? Because technically, if you buy one share for $135, you're getting $150 worth of assets. Well, it could be that people, just the market in general, have a bad feeling about the way this fund manager is managing the fund, or something. It could any number of reasons. We'd actually call this a discount because this price is lower. If it was trading at higher than 150, we'd say that the fund was trading at premium. So in any event, we have another video on that if you'd like to check that out, get into a little more depth. So right now, 400 shares times $135 a share is what you're going to be paying, and that's going to equal $54,000. This is what you pay for your shares. You pay $54,000. So now let's look at the fund's assets afterwards. Fund's assets, $6 million. Say, hey, wait a minute. I just paid $54,000. Well, yes, but you paid $54,000 to another investor to give you their shares. You didn't give it directly to the fund, right? So the fund, the number of shares outstanding is still 40,000, right? All you did was out of that initial 40,000, there was someone who owned part of that 40,000 and said, I'll give you I own 400 of those shares and I'll give them to you if you pay me $135 a share. That's all that happened. So from the fund's perspective, there's still 40,000 shares outstanding. So this is fixed. This is fixed, right? So now we shouldn't think of fund assets as being fixed because in this case, what we did doesn't affect fund assets, right? That 54,000. Fund assets can change over time, though, as the fund, earns dividends and stuff like that. The stock values that are being managed, or the stocks that are being managed, go up in value. But from our transaction, it doesn't affect the fund's assets at all, right? The capital we paid goes to another investor from the fund. So the net asset value per share right now, as a result of our transaction, nothing has changed. It's still $150 net asset value per share. So we notice that with the closed-end fund, we are dealing with another investor who has already invested in the fund, right? So when the fund originally opened, they sold those 40,000 shares, and then now these 40,000 shares are just out on the market, and whoever owns them can sell them for whatever price they want. They say, look, I'll take $135 a share. You say, okay, I'll pay that. I'll pay $54,000. Now you own those shares, but nothing changes with the fund's assets or the number of shares outstanding as a result of your transaction.